Hello, my friend. Welcome to Charley Retail Invest. Let's follow the latest trend in US economy and share our recent investment in stock and bond markets. Today is Tuesday, October 1st. The stock market has been on the rise and kept steady for almost 2 weeks after the Federal Reserve announced to cut benchmark interest rate by 0.5% on September 18. Among the major indexes, S&P500 has broken the previous record in mid-July and now is over 5,700, making a new all-time high. Many analysts do believe that by the end of this year, 2024, S&P500 will break into 6,000 level and may even reach 6,200, and the market is very bullish about the future performance of the stock market in US. If we look at the Fear and Greed Index from the CNN, we can see the market is quite greedy at the moment. Now the index is 73, which is just 2 points below the extreme greed territory. So definitely the stock market has been overbought since mid-September. Apparently, Federal Reserve's Chair Jerome Powell's remark that the US economy is strong and we can dodge recession have eased the market's concern for now. People seem to be optimistic about the stock market, and they keep buying tech stocks like Microsoft and Nvidia, thus pushing the index a bit higher. If we look at the top 14 companies that have the largest weightings in S&P500 index, we can see 8 out of the 14 are tech sector giant companies, including Apple, Microsoft, Amazon, Google, and Meta. The other 6 companies are the leading players in other sectors, including Berkshire Hathaway, JP Morgan, and Visa from the financial sector, and Eli Lilly and United Health Insurance from the healthcare industry. If we calculate the average year-to-date performance of the tech sector stocks versus non-tech sector stocks among these 14 big companies, we find that tech stocks have an average year-to-date increase of 41.9%, which is twice that of the average performance of non-tech sector stocks, which had a year-to-date increase of 20.7%. So tech stocks in general have outperformed non-tech stocks in 2024 by a lot. We all know the underlying reason that tech stocks rise sharply this year is the market's high expectation for AI or artificial intelligence to generate astronomical earnings for these tech companies in the near future. And whether there's a big bubble among these tech stocks for now would largely depend on if AI can indeed bring huge returns in the next 3 to 5 years. On September 18, Peter Oppenheimer from Goldman Sachs wrote an article saying that although tech stock prices are at all-time highs right now, there is no bubble in these financial assets, simply because these tech giants will continue to generate great earnings and reward investors with price increase in their stocks. However, the situation is pretty dire in the current stock market. That is, most of the money flowing into the stock market has been buying up those large tech companies like Apple and Nvidia, whereas the majority of small and mid-sized companies have a hard time getting investors' interest. The structural imbalance itself is a huge risk to the US stock market. The analyst also mentioned that investors should consider diversifying their portfolio and put some of their capitals into small cap companies or non-tech sector companies in order to mitigate the risk that the portfolio would be largely impacted by the performance of individual tech giant stocks. What it means to us retail investors is that Wall Street has admitted indirectly that the stock market is extremely expensive right now, and those big tech stocks are overbought. Although the Fed and the government keep saying that the US economy is strong and resilient, we need to be prepared in advance and avoid putting all our money into tech sector or stock market index right now. As a matter of fact, we should be very careful, and if we think about going big in tech, we will have huge risk of losing money when recession is factored in by the market, and the stock index might tank in 2025. The script has been written, and it's just up to the Wall Street when they want to play the recession playbook to short the US stocks and earn big money from retail investors. For us, it's much safer to sit back and wait until the market drops by 20% or more in mid-2025 and then start buying into stocks at much cheaper prices than today. Some of us might be concerned that as Fed starts cutting interest rates, more and more money will be printed out of thin air by Fed and pumped into the stock market, thus pushing it even higher than today. However, I think that scenario wouldn't happen just yet. This is because the benchmark interest rate as of today is still around 5%, far from the near zero level in 2020 and 2021, and it's also higher than the neutral interest rate of 2.9%. The Fed would need more FOMC meetings to cut down the interest rate step by step, which usually takes about 6 to 9 months to complete. Moreover, the Fed is still reducing its balance sheet, which means that the Fed is still selling its bond positions and sucking money out of the system, rather than pouring money into it. So we are less likely to see a stock market melt up, like what happened back in 2020 and 2021, when the interest rate was cut down to zero, and trillions of dollars were printed out of thin air by the Fed to pump up the prices of assets like stocks and houses. As of late 2024, all the companies whose stock prices are skyrocketing are big corporations with billions of capitals in hand. This is very different from the late 1990s. Back then, the small software companies generated lots of net incomes with very little money needed, and their profit margins are very high. Nowadays, small companies don't have a shot in AI competitions because it costs billions of dollars to build up the AI infrastructure, and small companies just don't have the cash to burn like the Magnificent Seven. This chart shows the amount of investment the tech industry has put into AI development, and it has been increasing since 2020. Experts estimate that the investment would double by 2025 compared to 5 years ago. That also explains why semiconductor companies like NVIDIA and TSM have been doing very well in recent years, as tech companies have to buy large amounts of GPUs and chips from them to build AI infrastructure. However, the flip side is if AI cannot generate astronomical earnings for companies who invested heavily for it in the future, then their stock prices are likely going to tank sharply. You can't burn billions of cash and have negative returns after all. In the meantime, NVIDIA's chip sales will probably slip down the road too, and semiconductor stocks may have a crash when their earnings miss market's expectation, even just by a little. Furthermore, the current scale of market dominance is greater than in other bubble periods before, including 2000, the internet bubble period. Right now, market share of top 10 companies has reached a new all-time high of 35% of the entire SP500 index, exceeding the 30% peak in 2000. We all know what happened between 2001 to 2003 when the internet bubble burst. The stock index had dropped over 40% in 2 years. So, as retail investors, we need to caution ourselves and not buy into the misinformation perpetuated by the mainstream media right now, that the economy is doing great and the stock market will continue to grow into the moon. On the contrary, it's a good idea to have some defensive investments, including treasury bonds, Bitcoin, and gold, or even have cash in hand. In this way, when the Wall Street is playing the recession card in 2025, we can avoid our portfolio to go down by 30% or more, and may even benefit from the stock market downturn. This is the most recent holdings of Charley Retail Invest Portfolio as of September 30. Compared to last Monday, September 23, we've sold all our holdings of Google stocks, We purchased a total of 110 shares of Google stocks around September 5th, and the average cost was around $148.6 per share. We've held Google stocks for 2 weeks and a half and sold them all on September 23. In total, we made a net profit of 10.2% with a net profit gain of $1,661 in less than 3 weeks, which is a pretty good performance in the short term. And we are not actually bearish on the future growth or earnings of Google, but we want to use the money to buy more long treasury bond ETFs, namely TMF and UBT, which carry 3 times leverage and 2 times leverage to TLT, respectively. If we compare our investment portfolio on September 23 to September 30, we can see that we sold a proportion of our TLT position and used the proceedings to buy leveraged bond ETFs, including TMF, UBT, and UST. Now, TMS weighting has been increased from 56% a week ago to 63%, and UPT's weighting also increased from 2.9% to 6%. What we are doing now is essentially increasing the leverage on long-term treasury bonds because we are quite bullish on the performance of long-term bonds over the next 6 to 12 months. This chart shows the 30-year treasury bond yield over the past 5 years. We can see that the yield is trending down as the Fed starts to cut interest rate. And the key question is, will the bond yield go even lower in 2025, or has it reached a bottom and cannot go down further from now? Well, the main factor that impacts the bond yield is the inflation rate, or CPI in the US. Right now, the market is fearful that Fed's cutting interest rate will spike inflation in the long run, and higher inflation will lead to higher bond yield, thus putting downward pressure on bond price. However, what we can see in the current economy is that American people, we're talking about middle class and the majority, not the super rich, are indeed struggling with the high cost of living, and they do have less money in the pocket compared to 2020 and 2021. In our last video on September 24, we described in detail how layoff waves have surged across different industries in the country. Today, if a worker gets laid off by a company, he or she would find it much more difficult to land a new, decent paying job compared to 2 or 3 years ago. Chances are that a job seeker applies for hundreds of jobs and cannot get any serious job interviews, let alone good offers from companies. On the contrary, employers across America are cutting their rosters to reduce operational costs in order to save money. Based on the undeniable facts, rather than the media's fake news, we believe the next problem is indeed deflation rather than inflation for the next year or so. Consumers will keep cutting their spending, and companies will keep laying off people until the Fed comes in to print trillions of dollars again in order to stimulate the economy. Only by then we might see the economy boom and inflation comes back. Therefore, we will continue to buy and hold long bonds and energy stocks, which are really cheap in price compared to other sectors, and wait for market sentiment to shift in 2025. Of course, if there's a short-term opportunity in Q4 of 2024 that we can buy into tech stocks or stock index at a relatively low price and sell them a few weeks later, we will do that to capitalize on those opportunities, such that we can have some short-term profits from those trades. The other main trade that we did over the past week or two was to sell Bitcoin-related ETF IBIT, which is reflective of the change in Bitcoin price. Because Merrill Edge does not allow trading of Bitcoin ETFs on their platform, we used our IRA account in Fidelity to do the trade. We can see that we sold all of our IBIT positions on September 23 to cash out all the short-term gains. We actually did purchase 180 shares of IBIT at a unit price of $30.2 per share on September 6 and have held it for 2 weeks. By September 23, we were able to sell all our IBIT holdings with a net profit of over 19% and a net capital gain of $1,038. We think that the current Bitcoin price has reached a peak level in 2 months, so it's very reasonable for us to cash out and secure the profit now. If there's fluctuation on Bitcoin price in the near future, we will consider buying into IBIT again and hold and sell for short-term profit. Of course, we will keep you posted if we see an opportunity coming. And that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charley Retail Invest. We really appreciate your support. You are also more than welcome to leave your thoughts on the stock market and our economy in the comment section below. Thank you so much for your time, and I'll see you in the next video. Please take care.